Tuesday, July 23rd, 2019, Maneco 64, home of alternative economics and contrarian views. So Billy and I are back at the headquarters. I'm glad to be home, be able to do my videos properly. So this morning I want to talk about how the United States government is spending like a drunken sailor. And why do I say that? Well, the Trump administration and Congress have come up with an agreement, a deal on the U.S. debt ceiling. And I also want to talk about how central banks don't create wealth. If anything, they destroy wealth and they redistribute wealth from the general public to the 1%. Before that, of course, I'll have a look at what the markets are doing this morning. I'm quite early this morning. It's just 5 minutes before 7 a.m. in London. So we've got gold and silver down a bit today. Still consolidating. I guess silver is outperforming. That gold-silver ratio is really looking like it's making a move lower for definite now. But as I said before, you never know in these markets. Right now, I've got spot gold down just under $10 at 14.15.29. The low has been 14.14 and the high 14.26. Silver, which did quite well yesterday, is down 0.75%. So down slightly more than gold in percentage terms. We're now at 16.22, down 12. Range has been 16.17 to 16.39. I think the high yesterday was around 16.44 for silver. We've got the Dow up 30 points, the Dow futures 27,202. S&P 500 up 2 points, 29.87, and the NASDAQ 100 futures up 4.5 points, 79.08. So still fairly quiet here. We've got sterling down 0.2%, 124.52. Euro down 0.2 as well, 111.89, and the dollar is up almost 1/3% at 108.17. Dollar yuan unchanged at 688.30. WTI crude up 7 cents, 56.30, and Brent crude is up 0.2% at 63.20. Bond yields, the 10-year yield is up just over 1 basis point at 206. The 3-month is at 209, so the curve is inverted by 3 basis points. First of all, I'll talk about central banks and why they can't create wealth and why this policy of money printing and QE doesn't work. And the proof of that, of course, is that they're going to keep doing it, especially in the EU or the Eurozone. They've had a massive amount of QE, and they're going to start again probably very soon. And we still get people like a guy called Rick Reeder, who is Chief Investment Officer of Global Fixed Income for BlackRock, one of the biggest mutual funds in the world. And he's written an opinion for the FT. And I'm surprised they publish this kind of rubbish because it's sophistry, in my opinion. That's what it is. And he's saying ECB can boost growth across Europe by buying stocks. Well, guess who would benefit from that, Mr. Reader? BlackRock. So that's what it's all about. So what does he say here? A specter of anemic growth is haunting Europe. More than 10 years after the global financial crisis, the unemployment rate in the US has recovered to reach its lowest levels in nearly 50 years. However, such a reduction has not been replicated in Europe, where high jobless figures in Greece, Spain, Italy, and France, an unhealthy skew in most countries towards youth joblessness are all causes for alarm. And he goes on to say, in addition, European companies are losing ground to their American and Chinese counterparts as torpid domestic growth stifles the desperately needed competitive stimuli of innovation and investment. This shortfall is highlighted by a ranking this year of the world's largest unicorns. private startups valued at more than $1 billion. Just 15 of the top 250 were Eurozone based versus more than 175 in the US and China combined. It is therefore time for the European Central Bank to improve private sector growth prospects by expanding its quantitative easing program to include equity investments in European companies. This guy's writing this rubbish in the FT. He works for BlackRock. I mean, central banks do not create growth. They do not create wealth. They just create money out of thin air, which is not money earned by work or savings or investment. So this is not going to work. Look at the Bank of Japan. They've been buying ETFs. Look at the Swiss National Bank. They've been buying stocks, or the FANG stocks even in the US. Look at the Swiss economy. They've still got negative interest rates. The way for Europe, in my opinion, to improve its conditions, its growth, is to cut the size of government. European governments, especially like in France, their government spending is almost half of GDP, so they're crowding out the private sector. The other thing, there's too many labor law regulations that discourages small companies from hiring. There's too much welfare. That's what it's all about. So it's free markets, deregulation, and also free markets in interest rates, i.e. not artificially low or negative interest rates that create wealth. If you allow interest rates to revert back to natural levels, which should probably be more like 5 or 6% in the Eurozone, you would have a lot more savings and investments, and you would have probably a lot more, how can I say, growth. The other thing I would point out, though, is that the reason the US is doing better, in my opinion, is not because the economy is better. It's just because the United States government is running huge deficits while the Eurozone isn't. I've got here economic and financial indicators, the latest one from The Economist. So according to The Economist, the budget balance for the US this year will be almost 5% deficit of GDP, 4.7%. For the Euro area, though, it's minus 1.2%. So the Eurozone is running a very small budget deficit, 1.2%. They're a lot more frugal, I would say. But yeah, the US is running 4.7%. So it's all in the debt. I'm not saying that US isn't doing better, maybe in terms of developing new companies. But that's one of the reasons why. And with that, I'll segue into the fact that the US is spending and will continue to spend like a drunken sailor, the United States government. So yes, White House and Congress reached deal on US debt ceiling. It seems great, doesn't it? But in my opinion, usually it takes a lot longer to get through this debt ceiling negotiation. This is too quick. So it just means that it doesn't matter if you're a Democrat, Republican, if you love or hate Trump, we're all gonna spend, right? So it says here, 2-year agreement announced by Trump would raise federal spending significantly. It had already risen significantly with the Trump tax cuts and the fact that he didn't cut the size of government. And I'm not against tax cuts, but it has to be also equaled with the equivalent cut in the size of government or spending, and that hasn't happened. Don't forget, this kind of deficits that the US is running, these are deficits that you run when the country goes into a deep recession to get the country out of a recession, even though I don't agree with this Keynesian, how can I say, strategy. That's what it's done. So right now, we're running huge deficits when the economy supposedly is doing perfectly and is the greatest economy in 50 years or so, right? So it says here, the White House has struck a 2-year deal with Democratic Party leaders in Congress to raise America's $22 trillion borrowing limit, removing the threat of a U.S. debt default and significantly raising federal spending. Well, this is from the FT, by the way. Well, I want to show you, I mean, the debt clock is already showing that we've gone through that ceiling. We're at 22 trillion 500 billion. So it's really amazing. So it goes on to say the deal crafted by Democrat Nancy Pelosi, Speaker of the House of Representatives, and Steve Mnuchin, the Treasury Secretary, increases the so-called debt ceiling until the middle of 2021, meaning the next big budgetary standoff would occur after next year's presidential election. However, the budget increases on top of sweeping tax cuts enacted by President Trump in 2017 raised new concerns about a lack of fiscal discipline in the world's largest economy. So the article quotes as well someone called Maya McGuinness, president of the Committee for a Responsible Federal Budget, a bipartisan think tank that argues for lower deficits, said the latest agreement was a total abdication of fiscal responsibility by Congress and the president. And I quote her, "There was a time when Republicans insisted on $1 of spending cuts for every $1 increase in the debt limit," she said. "It's hard to believe they're now considering the opposite, attaching $2 trillion of spending increases to a similar sized debt limit hike." So there you go. I think she's wrong saying that there was a time when Republicans insisted on $1 of spending cuts for every $1 increase in the debt limit. I mean, I've been reading this book. I haven't finished yet, War and Gold. Kwasi Kwarteng talks about how the United States, after World War II until the late 50s, the Truman and Eisenhower administrations and Congress, they were very frugal compared to nowadays. They run balanced budgets in the long term. If there is a deficit, they'd make sure they'd run a surplus the next year. Even the chairman of the Federal Reserve at the time, in the post-war era, William Martin, who served as chairman from 1951 to 1970, he was a sound money advocate. He was the guy who talked about removing the punch bowl when the party got too excited. Removing the punch bowl, of course, meaning tighter monetary policy. So for those of you who still doubt that you need to have physical gold or silver or precious metals to protect yourself against the total destruction of the Federal Reserve notes, because that's what it is, this should give you even more ammunition, not just the Federal Reserve and other central banks going back to cutting rates and printing money. Now you have this fiscal stimulus. And it's amazing that a president that is supposedly so despised by the Democrats and even some Republicans has been able to agree this. So that's one thing they agree on, is spending more money. So Uncle Sam, better watch out. He might get a really bad hangover. He's still spending like a drunken sailor. If you enjoyed this video, make sure you hit the like button. Make sure you also share this video far and wide if you think others would enjoy this kind of content. And you can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.